Hello, traders. James Stanley with StoneX and Forex.com. Welcome to 2026. As we come into the new year, I think it's really easy to be a USD bear. And conversely, as we came into last year, it was really easy to be a USD bull. But like we saw in 2025, the dollar set a fresh high on January 13th, so less than 2 weeks into the new year, and then went into a pretty vicious reversal that lasted for the first half of last year. The second half of last year, though, was marked by a grinding range in the dollar. And as we come into the new year, I think it's the drivers behind that range that loom the largest. And I think this is the reason why it does become an easy argument to be a USD bear. With that said, currencies are unique. If we are going to see the US dollar trend, it's probably going to need some participation from other currencies. So if you've watched my prior videos on StoneX, you'll know that I'm looking for the dovish push from the Fed, from Trump's fiscal stimulus via the Big Beautiful Bill to drive a rally in equities. I think it's also going to produce a very bullish backdrop in gold. But as to whether or not the dollar is going to trend, that question goes elsewhere. And I want to use this video to look at that. I also want to look at some strategy. I want to try to look what might be around that next corner for FX markets as we go into 2026. So let's get to the charts. So first and foremost, in the dollar, I think there's a lot of comparison here on this monthly chart to something that showed up in Eurodollar last year. On a shorter term basis, that is. As we came into 2025, this was a surging trend in the dollar, even as the Fed was cutting rates. And it was this doji in January. And I remember when that printed, it was almost like disbelief that it was going to turn into anything other than just a stall point in the rally. But February, we started to see bears gain some ground. And then in March, that's when economic data started to look really bad. If you remember, we had the Atlanta GDP Now read that indicated that the U.S. might actually show contraction in GDP. Well, that didn't end up panning out. As a matter of fact, the GDP read that we had in December showed quite a bit of growth, and I think that makes for a more difficult backdrop for the Fed to justify rate cuts. But the saving grace behind that is the fact that Trump gets to nominate a new Fed chair. And at this point, it seems like it's going to be one of the two Kevins. Kevin Hassett was the one that seemed to have the inside track. Now, Trump's been a little bit more coy with that. Now it seems like it's going to be one of the two Kevins, Kevin Hassett or Kevin Warsh, both of which seem to be pretty dovish. And Trump's even said that a willingness to cut rates is a litmus test for who he ultimately selects next. But again, currencies are unique, especially with the dollar. The dollar is simply a basket of underlying currencies, 57.6% of which is the euro. So if we look at this backdrop in the dollar, there's quite a bit of relation to the mirror image scenario in euro dollar. But remember this setup. We were stalled at lows, and we've continually retested this resistance. Like we retested this resistance from prior support in July. We tested it again in November. And so far, the reaction from that second test has held at a higher low. Well, if we look at Eurodollar on a shorter term basis from like a weekly chart, again, it's like a mirror image of that. As we came into last year, again, really easy to be a USD bull because we had this dramatic fall in Eurodollar, this dramatic rise in USD, even as the Fed was cutting rates. But in Eurodollar, we hit this stall, we hit this low at 102, that Fibonacci level in January. And then we held a test above it in February. That's when Trump started to bring in Europe for the whole trade war, trade tariff dilemma. Now, at that point, bulls couldn't make much fresh ground above the 105 handle. But bears were starting to let it slip. And then we got this higher low in late February, and then that's when the data really started to turn. That led to a bullish breakout from an ascending triangle, and that's where the reversal really started to take hold. A lot of similarities to that weekly chart in Eurodollar to the current monthly chart in USD. Now, a triangle, an ascending triangle, if we do end up with a higher low, it doesn't mean breakout until the break hits. So in Eurodollar, it was the 105 break that led to the fresh trend. And DXY, ultimately, it's that 100 to 100 spot 22 level that still looms large here. That was the 100 spot 22 was the swing low in Q3, Q4 of 22, or 24, excuse me. And then that came back in as resistance. But big spot, held the highs in July, held the highs twice in November, the pullback of which so far was unable to get down to that prior lower low. I mean, but again, bears have had an open door to go for that push. They've just failed to do so far. So I think we got to keep our minds open on trajectory behind both DXY and Eurodollar into next year. That said, If looking for USD weakness, I think there's a better area. If looking for USD strength, I think there's a better area. And then we can remove the dollar from those equations altogether and look at ways to avoid the USD. So first and foremost, if we are going to see directional themes in euro dollar, what I need to see there is the 115 level needs to get taken out to give rise for USD strength. 115 is a massive price in the pair. We've talked about that in these videos in the past. Like we had this 2.5-year range, 105 set the lows, 115 set the highs. And I think the way to consider this is the fact that not everybody in the FX market is a speculator pushing leverage. In many cases, you have like multinational corporations or global central banks, and they have actual usage for the underlying currencies. So if they see a euro spot go above 115, the euro seems expensive, the dollar seems weak. You're going to have to make payroll in the U.S. at some point. Maybe it's not a bad time to shift some of those euro reserves over into the dollar. Oh, lo and behold, now we have more demand for the dollar, less demand for the euro, and we fall back within the range. We get down to 105, same kind of thing. Euro seems cheap, dollar seems expensive. Hey, I've got to make payroll in Brussels. Maybe I'm going to swap out some USD for euros, and then that leads to demand and a run back up to resistance. That's why I think many times these big major psychological levels, like we saw at 125, will have a tendency to show up as support or resistance. Now, markets are always going to have a degree of non-predictability, but the reason I think these levels and support and resistance are so impactful is because if you see this, and you see something like we had in November, where you have 3 consecutive days of support dancing right on that 115 level, you don't know what's going to happen next, but you know where you're wrong if you implement an if-then statement. If we break below that low and that higher low does not hold, and we get a closed body break through the 115 handle, well, then the support that you're looking to hold is not playing. And so you know where you're wrong. But if it does, then the possible upside, the possible run off that reversal, that support hold, could be sizable. And that's exactly what played out in the second half of the last 6 weeks of 2025 trade. Nonetheless, if we take a step back, bulls are still at an area where they've continued to stumble. And it's the same 764, 786 Fibonacci retracement produced by the 2021 to 2022 major move. The 23.6 is what ultimately caught the low last year at 102. And again, it was really easy to be a USD bull, euro dollar bear at that point. But you can see we had 2 consecutive indecision candles on the monthly reversal. And so far, it's been like 6 months of resistance playing at that very same zone. That very same 764, 786 zone. If we break 115, that's going to look like it's topped. On the upside, if we break significantly above 119, then we have to contend with the 120 level. And I think that's something that could become problematic. Because then, and again, we're talking about currencies here, so there's an actual usage point behind it. But if we get a 120 spot in euro, that's something that I think the ECB is going to be somewhat disturbed by, because it will act as a headwind for European growth. European producers are going to have a more difficult time selling products in Europe. Imports are going to, by nature, seem cheaper, more attractive, especially if we look at something like autos, or Chinese autos especially. That then becomes more difficult for European auto manufacturers to sell cars domestically, and then thereby hits inflation, hits employment, and then that's something that could actually lead to European rate cuts at some point in time. And as a case in point, all you have to do is look back at what happened in the other direction in 2021 and 2022. We had this episode where euro weakness took over en masse. Fed's hiking aggressively, the ECB's not keeping pace. What ends up happening? The U.S., in essence, is exporting their inflation to Europe. That's precisely what happened, and the ECB eventually had to come to the table with more aggressive rate hikes in order to stem inflation. So ideally, I think these central banks, especially the ECB and the Fed, they want to see some degree of stability so that actual fiscal policy can play its role. But euro spot at 120, I think that's something that would compel the ECB to start trying to talk it down a little bit if we get into that scenario. Nonetheless, if looking for USD weakness, I still think there's a more attractive backdrop in cable. This is one I've been following ever since early November. And that setup has continued to produce higher highs and higher lows over the past couple of months now. 135 is the level that bulls have not been able to make much of a stage beyond yet. But there's some very adequate support structure underneath that I think remains attractive. So if looking to push USD weakness, I have an S1 level I'm using this 34.14 level, but I could zone this down to that swing low to call that entire zone like an S1 area. S2 is a zone that's already been used quite well, but given how these 3 candles danced at that level, at that zone, I would still be willing to take another retest in that zone as bullish continuation or 4 bullish continuation setups. And then S3, I'm looking at this swing low, which seems significant. If we get a closed body break below that, that's where dollar strength is going to start looking more prominent. At that point, that's where I'm going to want to look at euro dollar to see what the odds of a 115 test might be looking like at that point. But if looking for that USD strength, I think there's another venue elsewhere. Predominantly right here, dollar yen. This is the one that I've been following for USD strength for a while now. And, again, we can simply compare this to that broader DXY chart. And there's a deduction here that I think still matters. So the real hit to USD was like March, April of last year. And it was produced by that fear on tariffs, the repercussions of tariffs. And we can see that prominently priced here in dollar yen. But it was around April, earlier in April, like April 10th, April 14th, when Trump started to back away from the whole tariff thing. That's what helped to get stocks or bring stocks back to life in a very big way. And I think not coincidentally, that's when dollar yen bottomed and started to rally and go the other direction. The range was pretty grindy for the rest of H1 and even through Q2 or Q3, excuse me. But it came to life in a big way in October on the back of Japanese elections. And I think that's what looms large right now. And again, if we just notice a simple deduction, even with the dollar kind of still holding very near those lows, even though we might have a higher low, dollar yen has been flying higher, especially since that October election. Now, when we came into December, it was like a foregone conclusion the BOJ was going to hike. They prepped markets pretty well for that. But that's when you started to see sentiment turn. I started to see a lot of people trying to call a top in headlines, and maybe something like that ends up working out. But ultimately, it's when the market is less or least attractive to the crowd that it's most attractive to me. And we can see where we had this pullback develop in November and into December. It was pretty textbook. Support held right around prior resistance, 154.45 to 155. Notice these underside wicks on these candles. Almost beautiful the way that it played. Built this nice little falling wedge, and then we broke out from that. And then the retest of 154.45 again held. And then we go right back up. That was the BOJ rate hike. So BOJ hiked rates, but they're not going to commit to more rate hikes unless they absolutely have to. Even the rally from that led to another higher low. And so at this stage, bulls are still doing the driving here. If I'm looking to push USD strength, this is still the area that I want to do it. If we get up to 160, things could start to change. I still don't want to chase breakouts in the pair, and I've been saying that for the better part of the past year because there have been a number of these that have ended up turning around aggressively or viciously, and that's not something I want to get caught in. But a pullback to support, I'm still open to. Very much like we saw back in November and December. The paradox of that is it's when the headlines look the nastiest that setup might look the most attractive. And that's what ended up showing a couple of different times, November and December. And that's kind of where we're back at. Now, at this point for structure, this 154.45 to 155 zone is shown 2 decent bounces already. I don't want to rule that out until we get a break up to a fresh high. For now, 155.54 would be the more ideal place for higher lows to hold, but if we don't, it's not necessarily a deal breaker, because even like a 155 print, especially if we hold above that swing low from earlier in December, then I think it still is viable for higher lows and higher highs. Where I want to get a lot more conservative is once we get above that 158 level, and the reason for that is the history of 160. 160 was defended by the BOJ back in April of 2024. We had an 800 plus pip pullback in a really short period of time, and we just went right back up. And then 160, the BOJ was told to intervene by the Ministry of Finance again, and they dropped a hammer, and that triggered a massive unwind theme on the Japanese yen. This is the risk factor behind bullish continuation in dollar yen. We get something like that at some point in the year, but that also brings with it collateral damage, as we saw then. But we're not there yet. That's just why I don't want to chase breakouts, especially above 158 at this point. If we get above 158, got to wait for a pullback. And this zone, that's current resistance, then becomes viable for that pullback potential. And then last, most certainly not least, if you want to avoid the dollar altogether, that's cool. I get it. We could go over the two different setups that we just looked at, and we could remove the common variable of the USD. So we have, I mean, you go back to old school algebra, pound over USD, USD over the Japanese yen. Cancel out the USD, you make pound yen. So let's do that. We can take the British pound strength that's shown against the USD. We can take the Japanese yen weakness that's shown against the US dollar, and we can make an amalgamation here. Lo and behold, pound yen is trading at fresh 18-year highs. And I've been talking about this one quite a bit. You'll notice it's been virtually parabolic over the past couple of months. But I don't want to chase anything because trading is psychology. And if you let your emotions get the best of you and then it doesn't work out, you end up beating yourself up because you're at fault. You didn't follow your plan. You weren't patient. You didn't prioritize risk. It's your fault. And the only one to blame is you. So it comes down to the equation because you're never going to know what's going to happen tomorrow. You're never going to have a crystal ball. It comes down to the equation. Would you rather miss a setup, an opportunity, or would you rather lose capital in chasing a suboptimal setup? It's up to you. Me, I'd rather miss an opportunity because if this one doesn't work, I got a bunch of other stuff that can. But you know, a pretty clear area of prior resistance, the 208.12 level. This had some intraday play that worked somewhat well. You'll see the support off the 4-hour support again. You know, again, if you're watching this short term, this is the kind of stuff that you could catch off like a 4-hour chart. But off the weekly, even off the daily, we haven't really seen much for support there yet since we had the breakout. And so that automatically is my S1 off this weekly chart. So that would require a bit more of a pullback to bring that into fruition. Shorter term off the daily, I'm pulling this zone is simply a prior swing high to this lower high. This zone runs from like 204.25 up to around 205.33. You'll see there's some support on both sides of that zone, on both sides of that range. And then taking another step back, this area of prior resistance did show a bit of support, but that's my S3 for right now in pound yen. So if you want to avoid the dollar altogether, that's possible. If you want to take a shorter term look, you can do that too. Right here off the 4-hour chart, notice there's all this sink around that swing low, right around the 210.30 handle, which I'm just going to call this 210 flat. And that becomes short-term support to look to. So it's not just price coming down into this zone that makes that a viable long or a bullish setup. It's price coming down and then seeing a reaction with these underside wicks, such as we saw here in these two instances. The reason for that is because you know where the line in the sand goes. You saw the reaction. For that support to hold, we need to push higher highs and higher lows. If it doesn't, if we come down and we dip below that 210 or below that swing low, it's not holding. The if-then statement is null. You don't want to be sticking around to see how wrong you might have been. But the shorter term you get, the noisier text can become. Going down a bit deeper, it's like 208.95. There's another prior swing high that hasn't yet shown much for support. So a couple of different ways to take this on a shorter term basis if looking to push those broader, bigger picture themes in the cross current of the British pound and the Japanese yen. But that, my friends, is what I have for today. Want to wish you guys Happy New Year. I hope you have a great and prosperous new year ahead. And as always, thank you very much for your time.